He's talking about it. So make sure you pay attention and watch to the end of this video. It's very important that you understand how they're trying to rip you off. I'm going to explain this to you in 3 simple, fast steps. Step number 1, we're just going to go over the basics very quick. Tax brackets. If you're making $0 to $30,000 a year, in this example, we'll say you're taxed at 10%. 31 to 70, 15, 71 to 200, 20, and 201,000 and over, you're taxed at 30%. There's 2 different ways of looking at the tax brackets: the marginal tax rate and the effective tax rate. Just because you make $201,000 doesn't mean all of your income is taxed at 30%. The first $30,000 of your income is only taxed at 10%. So the marginal rate is just the top rate of tax that you're paying, and the effective rate is the combined total. In today's example for this video, we're just going to use the marginal rate as though it was the effective rate. The key takeaway for step number 1 is that if your income goes up, you pay more or a higher percentage of your income in tax. Step number 2, the new tax plan, or the new tax scam, as I like to call it. It starts with the way the government measures inflation. 2 different options, the CPIU and the CPIU. Starting at 2000 going to 2018, we're pretty close to the same. But as time goes on, we get that compounding effect to now where we are today. The CPI way of measuring inflation shows a lot more inflation in the actual economy than the CPIU. That is crucial that you understand that. So let me just reiterate one more time. If we measure inflation based on the CPIU, the inflation rate is much higher than if we measure inflation with the CPIU. And to understand how this affects you and how much money you actually pay in taxes, let's go directly to the Federal Reserve's website. This is a blog post that we'll link to in the description below from the Federal Reserve's website. The blog post is titled "New Tax Code equals New Price Index equals New Tax Bracket Adjustments." The new Tax Cuts and Jobs Act changed both personal and corporate income taxes. Much of the discussion has focused on the changes in the tax rates, but there's another change in this law that has an effect on personal income tax. The Act continues to adjust the tax brackets for price changes, as did the prior personal income tax legislation. The difference is the price index used to adjust those tax brackets. The previous tax code used the CPIU measure to adjust the tax brackets, while the new tax code uses the CPIU measure. Did you get that, guys? The old system used the CPIU to determine how fast they move those tax brackets up. The new system, the new tax plan, or the new tax scam, uses the CPIU to determine how fast those tax brackets move up. And that's very, very important. To understand it further, let's go back to the Federal Reserve's website. The prices, or inflation, in the CPIU index increase at a slower rate. As shown in the graph, the CPIU implies smaller price increases than the CPIU. This means the tax brackets will have smaller adjustments and more individuals. That means you, the taxpayer, will fall into higher tax brackets and pay more taxes. The bottom line is this is a covert operation where the government is intentionally pulling the wool over your eyes. So a politician like Donald Trump can go out there and tell you how he's lowering the tax brackets to save you money while at the same time taking more money right out of your pocket without you even knowing. Oh, but wait, there is more. I've got a bonus scam for you that I found while doing the research for this video. This is so egregious that it actually gets two pissed off frown faces. If you're not pissed off already by the new tax plan scam, trust me, this is really going to send you over the edge. We're going right to the official Social Security website. OASDI, in other words, Social Security, benefits are indexed for inflation to protect beneficiaries from the loss of purchasing power implied by inflation. In the absence of such indexing, the purchasing power of Social Security benefits would be eroded as rising prices raise the cost of living. And now we really start to connect the dots. The BLS, or Bureau of Labor and Statistics, has constructed a new index called the Chained Consumer Price Index for all urban consumers, or CCPIU. Does that sound familiar? And if you're currently receiving Social Security, or if you ever plan to in the future, now it's time to sit down and pour yourself a stiff drink. Listen to this. Any changes to the cost of living adjustment that would cause faster growth in the individual's benefits would make the projected date of insolvency. They're admitting that Social Security is insolvent. So the projected date of the insolvency would be sooner, while slower growth, meaning paying you less, would delay the insolvency. The bombshell here is, of course, they're admitting that Social Security is completely insolvent. So get your mind around that for a moment. Second is the only way that they can continue to kick that can further down the road is to screw you by paying you less with the same covert operation that pulls the wool over your eyes by changing from the CPIU to the CCPIU. Simply put, if they measure inflation this way, you get $1,000 a month. If they measure inflation this way, you only get $900 a month. Step number 3, how the CPI tax scam plays out in the real world. And keep in mind, guys, I'm using the marginal rate as the effective rate. I know they're different. I'm just doing it to keep things simple. So right now, if you make $38,000, you are taxed at 12%. That tax bracket starts at $9,701 and goes to $39,475. If you make $83,000 a year, you are taxed at 22%. That tax bracket, $39,476 to $84,200. So how does this play out in the future? We've got to start with recognizing the fact that the federal government is totally insolvent, the largest debtor nation in human history. And the only thing that can bail them out is inflation. So the Fed comes in and says, okay, fine, federal government, we'll give you the inflation that you need. We're going to start by changing the definition of stable. Their mandate is stable prices. And I don't know what your definition of stable is, but mine is that prices stay the same. Well, the Fed changes that to mean that now stable is prices always going up. But let's think about how ridiculous that is. Let's say that you're someone who's morbidly obese. You weigh 400 pounds and you go to the doctor and the doctor says, oh, I think we need to keep your weight stable. And you say, okay, so I need to keep it the same. He says, oh, no. We need to increase your weight. You need to gain at least 2 to 3% per year. That's how ridiculous the change in definition is. And then they go from stable prices to now they need to target inflation. Okay? Well, then they go from targeting inflation at 2% as though that's healthy for the economy to saying, well, that targeting, that doesn't really work. We're going to start averaging inflation. So we're going to have a specific target rate at, let's say, 2 or 3%. But if we run lower than that for an extended period of time, well, we're just going to run the economy hot to make up for it. Basically, what they're just saying is that they're going to run the economy hot. And if we look at shadow stats, they're saying that the current rate of inflation is at least 10% if you were to measure inflation the same way that the government did back in the 1970s. And let's go back to the CPIU measurement. This is the way the government is pulling the wool over your eyes because it understates inflation dramatically. And this is what they're using for these tax brackets. So let's say that the real rate of inflation is 10%, but this measurement of inflation that they use for the tax brackets is only showing 2%. In 20 years, our tax bracket for the 12% rate would go from the baseline of about $9,000 to $14,000. The top line would go from $40,000 to $58,000. With our second example, which was the 22% tax bracket, that goes from $39,000 to $58,000 and from $84,000 to $125,000. But that's increasing by 2% per annum. If inflation is actually 10%, then the person that was making $38,000 a year in 20 years will be making $255,000 a year. And you may say, George, well, that's amazing. That's fantastic. No, it's not. Because even though nominally you're making more money, you don't have any more purchasing power. It's the exact same thing. And the person that was making $83,000 over here is now making $558,000 a year. Again, with no more purchasing power. Well, what does that do to their tax bracket using this cooked up phony inflation number that the government changed to in their new tax plan / scam? It would move the tax rate on the person making $38,000 a year from 12% to now 32%. It would triple their taxes. And the person that's making $83,000 now, that's paying 22% in tax, it would move their tax rate to 35%. You can see how this negatively impacts people who are poor and middle class a lot more than it does the rich. And let me break this down in a very simple way. If right now you are making $38,000 a year, or you have $38,000 in purchasing power, you're paying roughly $4,500 in taxes. $83,000 in purchasing power, $18,000 in taxes. With the scam, in 20 years, if you're making $38,000 in purchasing power, you'll be paying $12,000 a year, $83,000, $29,000. So you go from paying $4,500 in tax to $12,000 in tax, $18,000 in tax to $29,000 in tax. That's for the poor and middle class. And you may be saying to yourself, yeah, George, I know, but I don't think that prediction's actually going to come true. Let me be very clear. This is not a prediction. This is a foregone conclusion. This is the end game. The politicians, and I don't care who they are, it can be Warren, it can be Trump, it just doesn't matter. They are left with one choice and one choice only, and that is to tax the living daylights out of the poor and the middle class, because there's just not enough rich people to pay for the debt time bomb that the government has created. 23 trillion in on-balance sheet debt, 100+ trillion in off-balance sheet debt. And let's not forget that Social Security is totally insolvent. And it goes back to the Federal Reserve. Why is that? Because they come in and create this boom-bust cycle by dropping interest rates artificially low. Now we are in a massive everything bubble, and every single time we go through the bust cycle, the government comes in and spends massive amounts of money. They deficit spend till they're blue in the face, and this gives us the national debt that we have now, and this requires us to tax not only the rich, but the poor and the middle class. This entire CPI tax scam goes back to one thing, and that is the Federal Reserve. I don't often ask this, but I'd really like each and every one of you to share this video. I think it's vitally important that all Americans know exactly what's going on. And if you want to share that blog post from the Federal Reserve, we're going to put a link in the description below so you can read word for word the tax CPI scam. For more information like this, check out this content right here, and I will see you on the next video.